All right, thank you very much, Eric. So as Eric mentioned, my name is Richard Thakor. I graduated out of the finance PhD program here in 2016. While I was a PhD student, I really had the privilege of first getting to know Bob as his teaching assistant in a course called Functional and Strategic Finance, which basically tried to distill a lot of the ideas that Svi talked about with the functional perspective. And then I had the honor of being able to collaborate with him on research after that, and that's something that we're continuing to do as well. So it's really an honor to be here. Basically, Bob has been just such a tremendous influence on me, and has really been a tremendous mentor as well. So a mentor both in terms of intellectual ideas, but also in terms of his generosity. So I'm always floored by just the amount of time and the amount of wisdom that he conveys to me in every single conversation, even when I was just a second or third year PhD student. So I think beyond his accomplishments, that's really been something that's been special to me. So what I'm going to try and talk about in the rest of the time that I have is the topic of trust. And this is a topic that Bob, in particular, over the last 2 or 3 years, and I think going back a little bit further, has emphasized more and more in research and presentations worldwide. So put up just a chart, and this is, I think, a really incomplete list with the stars here of just some of the places that he's been just over the last couple of years talking about this concept of trust. So what he has done is highlighted this concept of trust and its role in the functioning of financial markets and institutions in general. Now, in terms of trust, I think at an intuitive level, a lot of us really understand that trust in financial products and institutions is often essential for financial markets to function. And this has been noted in a lot of different contexts by a number of people. For example, since the origins of banking, trust has really played a foundational role. You go into basically an older style of bank, and you'll notice that the outside is made of really, really strong-looking material, a lot of tall pillars, and so on and so forth. You go to the inside, and you'll see vaulted pillars, marble floors, so on and so forth. So they're really trying to emphasize to you that you can trust that institution with your money if you go in and deposit your money there. So in terms of this function, say, of banks, I think that to a lot of us, the importance of trust is relatively clear. Basically, you don't want them to run away with your hard-earned money. But what Bob has emphasized, I think, is that this notion of trust encompasses this concept with the safekeeping function of banks, but a lot more. And that this notion of trust really plays an even deeper and broader role in the functioning of the overall economy, and in particular, the evolution of the financial system. And what I'll argue here is, in connection with what Svi talked about with the functional perspective, I think this creates a very powerful framework. And in particular, a powerful framework that helps us to understand a lot of even very recent developments in the financial system and the economy that a lot of people have struggled to explain or don't think can be explained in our traditional frameworks. And just to give a preview of some of the things that I think can be understood in this framework of trust are things like financial crises, financial advisors and wealth management, and the changes that have been happening in terms of the influx of financial technology or Fintech, and also more generally the information environment that companies operate in. So I'll try and describe how I think it's connected to each of these by the end of the talk. So just to outline what I'll talk about, I'll first try and define what trust is in terms of the framework that Bob and I have been talking about and what he has had in mind. I'll then talk about some of these applications once I've tried to define this of trust in terms of the things that I just mentioned. And then I'll have some concluding thoughts on basically where I think this might take us going forward. So first, I think a challenge, at least theoretically, in the literature has been to provide a formal definition of what exactly trust is. I think a lot of us have some sort of intuition, or at least a thought in our mind, for what exactly trust is. But it turns out that in the economics literature, it's not entirely clear. And I think that Bob has really made headway into overcoming this challenge. And so a lot of what I'll talk about here is drawn from both our joint work as well as conversations with him and his presentations that he's done worldwide. And basically what he does is that he emphasizes trust has two basic components. The first component is competence, which is about skills. And then the second component, which I'll spend most of my time talking about, is trustworthiness, which is about intent. And this distinction, I think, is important in practice for sharply defining what trust is, as well as what it's not. So first, I'll talk about competence. So this competence component of trust is about skills. And basically, you can think of it as asking, is a person or a company that you're trying to evaluate, do they have the skills or are they able to act in a good manner? Okay, and Bob basically mentioned to me in one of our talks that a good way to think about this is that a completely trustworthy but incompetent firm can make decisions that are just as bad as an untrustworthy firm. So competence is really an important component of this. Bob gave an example of this which really stuck in my mind, which is that you may trust your children, but you would not trust them to perform surgery on you unless they're trained medical doctors. And this really, really got seared in my mind because I immediately thought of my own children who are there. And as you can see, they're not competent to perform surgery on me, and if they did, it would probably be like out of the scene of a horror movie. So that's the competence component of trust. The second component of trust that I'm going to spend most of my time talking about is the trustworthiness component. And what this is about intent. And you can think of this as asking the question of, will a person or company, given that they can act in a good manner, will they choose to act in a good manner? Put differently, in conjunction with competence, a person may be competent, but you may still choose to not transact or interact with them if they're not trustworthy. Now, from a theoretical perspective in the economics literature, this is often thought about as how good of a reputation one has. And this is basically, I think, an adequate framework in a lot of cases to think about trust. So statistically speaking, you can think of this as the prior that you're a good type in a Bayesian type of model. But I think that there are some additional features to trustworthiness that are not very well captured by this simple statistical framework, and basically Bayesian updating. And these are some of the components that you might think about that I think are intuitive in terms of trust, but are not necessarily well captured by this. So again, this is observations about trustworthiness. So will an entity behave in a bad manner? The first is that it's often been noted that trust is either a 0-1 property. So you either trust someone or you don't. The second is that if you trust someone, oftentimes you'll think that there's no possibility that they'll act badly. And in fact, if you see some evidence that may be consistent with them acting badly, you'll just throw away that evidence. To the contrary. A loose analogy would be if I just left my wallet in a room with people I trust. If I come back and the wallet is gone, I don't think that there's any chance that those people, if I trusted them, took my wallet. It may be that I just thought that I forgot the wallet somewhere or kept it somewhere else. And the third thing here is that if trust is broken, oftentimes it's completely unexpected, and it results in essentially a paradigm shift. In other words, the world does not work in the way that you thought it worked previously. So I'm going to talk about this. What we try and do in our recent joint work is we attempt to incorporate these observations formally in a theoretical framework. And what we try and do is, through this framework, provide a distinction between what trust is and what a normal, basically Bayesian reputation framework delivers. And this is going to be, in statistical parlance, something that's partly Bayesian and partly non-Bayesian. So what I'll do is I'm going to describe this framework just in a few minutes, and then talk about how I think this framework can be applied to a lot of the things I mentioned at the beginning in terms of understanding the financial system. So what we do in the paper is we look at two different types of uncertainty. One is uncertainty between models of the world, and the second is uncertainty between types within a given model of the world. So you can think of it as follows. There are two different models of the world that you can operate under when you're looking at a given company or person. The first is model 1, where you're looking at a trusted firm. And if you operate under this model, you think that that firm will never engage in bad behavior due to self-interest. The second model of the world is if you're looking at a non-trusted firm. In this case, you think there's some chance that that firm will engage in bad behavior. Now, they may choose not to, but there's at least some probability that they will. And in this case, we'll say that you don't trust that firm. Now, I'm going to show you a picture that kind of lays this out, and I'll try and walk through it. But the gist here is that if you trust a firm, you operate under model 1. And in particular, you think that that firm will never engage in bad behavior. You'll assign prices and then negotiate contracts according to that. And in particular, evidence that the firm behaved badly, some of that evidence that may be inconsistent with model 1, you'll throw out. You'll basically mentally discard it and think that it's due to bad luck or some other circumstance that's not due to the firm behaving badly. If you don't trust a firm, you operate under model 2, in which case you'll assign prices and contracts accordingly. And evidence that a firm behaved badly is going to be consistent with model 2 in the sense that you always thought there was some possibility that the firm will behave badly, and you'll update your prices accordingly. And as I'll talk about, losing trust you can view as a paradigm shift between model 1 and model 2. That you operate under model 1, you think that the world worked in a way where the company never engaged in the bad behavior. You then observe something that's so inconsistent with model 1, you then move to model 2. And what we argue is that this ends up being something that is such a big shift that it's very sharp, it's jarring, and it's discontinuous in terms of prices and other outcomes. Okay, so just in terms of pictures, and hopefully this isn't too small to see, you can think of it as follows. You first start by ascertaining whether an entity is competent or not competent. If they're not competent, you don't contract with them. If they're competent, you then go and then you see if they're trustworthy or not. If you think they're trustworthy, you'll operate under model 1, and you'll use that as the model of the world for basically appraising that firm. If you don't think they're trustworthy, you think they're self-interested, you'll go into model 2 and operate as if that's the model of the world. And in particular, in model 1, if you trust the firm, basically that firm is going to get the best contract terms and prices because you'll price everything basically thinking that you trust that firm. In model 2, you'll basically have some prior that the firm maybe behaved badly, and you'll price things and set up contracts based on that. And these contract terms and prices will ex ante just be worse than if you trusted that firm. You'll then observe some sort of outcome. And in basically the paper that we do, it's about banks, and you observe loan outcomes, but you can think more generally as observing some sort of outcome. You then see, based on that outcome, probabilistically, is that consistent with the model that you are operating under? And if it is consistent, then you don't reject this model, and you update your beliefs within this model. If it's inconsistent, then you go back here, and then you potentially switch between models. So here's how you can think about it. If you start off in model 1, again, you trust the firm, you have the best contract terms and prices, you then go and observe an outcome, and let's say that outcome is relatively good. Well, in that case, you'll continue to trust that firm. There's going to be no change in outcome. So even if the outcome is bad, you attribute that outcome to luck. And so you discard that in terms of your model. And you continue operating as if you trust the firm. So slightly inconsistent evidence may be ignored. In contrast, let's say that this observed outcome is very bad, and it's so bad, in fact, that it's completely inconsistent with the model of trusting. It's just that outcome just could not probabilistically happen if you were right to trust that firm. In that case, trust can be broken. You reevaluate your model of how you view the world in terms of that firm, and you may shift to model 2. And this is going to be a very big shift between model 1 if you trusted the firm and model 2 that you don't. Now moving on, if you operated under model 2, basically you didn't trust that firm. You always thought there's some chance that firm might act badly. You then observe an outcome. And basically, these outcomes, whatever you observe, what we show is that it's going to be consistent with model 2. A good outcome you can think of as just saying that firm just chose not to act badly. A bad outcome is basically confirming your prior that there was always some chance that firm could act badly. And so what you'll do here is then you'll update your priors in a Bayesian framework. So you'll statistically update how likely you thought it was that firm was going to act badly. And then you'll change your contract terms and prices accordingly. An interesting thing is that if you operate under model 2 and you did not trust that firm, what we show is that it's very hard to reject model 2 and go back to model 1. Put differently, if you did not trust the firm or you lost trust in that firm, it's very difficult to go back to trusting that firm. Basically, any outcome statistically that you see is basically just confirming how likely the company was to act badly within model 2. So this will give basically the conclusion that you can have trust. If the trust is lost, it can be broken depending on the outcome. But it's extremely difficult to regain trust once you've lost trust. Okay, so that in a nutshell is the process that we try and define theoretically in our model. And again, just to emphasize, the key takeaways here is that first, a trusted individual or firm will be able to get contract terms or prices at the most favorable terms. Second is that trust will insulate firms from adverse reputational consequences of bad outcomes. So if a company is trusted and something bad happens to that company, agents will just tend to ignore these outcomes. Third is that trust can be lost, and if trust is lost, it will cause a large and then discontinuous shift in outcomes. Put differently, your previously held model of how you thought the world works will no longer apply. And then finally, losing trust will be easier than regaining it once it's been lost. So an analogy that I sometimes use in presentations actually comes from Law and Order. It's a pretty frequent plot line in Law and Order, or specifically Chicago PD, which is a show that we really like to watch. So there was a particular episode in Chicago PD where basically a professor was trying to cross the Canadian border, to teach a class. So I live relatively close to the Canadian border, so there were some parallels here. Where the parallels end is that he was stopped at the border because he was carrying, I think, 5 kilos of drugs across the border. So the police stop him, they bring him in for interrogation. He, of course, denies absolutely everything, doesn't know how the drugs got into his car. And then his wife is brought in for questioning. And the police show his wife a lot of evidence that's just consistent with he's been doing this route a lot before. There's evidence that when they trace it out that he's been actually carrying the drugs before. And they come and question her about 3 or 4 times. And every time she denies that there's any possibility that he could be doing this because she trusts her husband implicitly. And so she discards any of the evidence, even when it's getting more and more convincing by the police. And then finally, the evidence becomes so irrefutable in the sense that her husband eventually confesses, and they actually have him on video, and they provide additional evidence that he was in fact doing this, that then the trust is broken. And of course, by then, she had ignored all the previous evidence, and it was a very, very jarring shift between trusting someone and then understanding that they're not at all who you thought they were. So with this framework of trust in mind, what I want to do is connect this to Bob's previous work on the functional perspective in finance. And the basic idea here, as Fee had mentioned previously, is that one of these ideas in the functional perspective is that we can think of financial institutions not in terms of the labels we put on them, but on the basis of the core economic functions that they perform for us. And so a body of work by Bob and Svi has basically laid this out, I think, in very nice terms. An example based on previous work that Bob and I had done is, one example is applying this to banks. So what we mentioned in this paper based on this previous work is that banks rely on funding from customers and investors, groups for which basically the functions banks serve are fundamentally different. And this will yield a host of implications for efficient contracts and regulatory practices. Basically, you can think of a customer as someone like a depositor who gives money to the bank. They don't want to be exposed to the bank's risk. An investor is someone who puts money into the bank and expects to be exposed to some risk in a risk-adjusted return sense. Now, what I'm going to argue here is that combining this framework of trust with the functional perspective will create a powerful framework to help enhance our understanding of the financial system. And in particular, we can understand many recent market developments if we understand first the basic economic functions that are at play. And once we've done that, then we can try and understand how institutional structure may affect agents' responses through channels such as trust, which I'll emphasize here. And in my remaining time, I'll just talk about some applications of if we combine trust with the functional perspective, what we can explain, which include the financial crisis, fintech lending, financial advisors and wealth management, things like blockchain and digital currencies going along with fintech, and if I have time, and I may not, in general, some ongoing work for informational transparency. And what I want to underscore here is that all of these different concepts, especially in the last 10 years, have been what a lot of people have noted are fundamental changes potentially to the financial system. You'll see a lot of articles talking about how things like fintech lending, blockchain, and digital currencies are just so new and so fundamentally different from what we understand in our traditional frameworks that it almost can't be understood. And what I'm going to underscore here based on Bob's talks and this framework is that I think this actually gives us a very practical and nice framework to actually understand these fundamental shifts in the financial system. So the first connection that I'll talk about is the financial crisis. So as we all know, the financial crisis in 2007 to 2009 is widely regarded as the worst or one of the worst economic events to happen since the Great Depression. There are a few stylized facts about the financial crisis. So in particular, a number of people have noticed that what we saw was a very sharp and discontinuous increase in risk premia, in particular in markets like bilateral repos, where prices moved in a certain way before the crisis, and then they shifted in a very jarring manner as the crisis hit. The second is that a lot of markets, when the crisis hit, all of a sudden froze. So a lot of companies were relying on markets like the European interbank market to basically fund themselves. A lot of banks were. And suddenly those markets froze in that they were no longer functioning, and firms could no longer get funded. And then third is that there's a good deal of evidence that risks that were penalized during the crisis were not even contemplated prior to the crisis. So in other words, they were viewed as zero probability events before the crisis, and then suddenly they were priced in. What I think this is consistent with, there are of course, other explanations for this, but what I'll argue is that this is also consistent with this framework of trust that Bob has been developing. It's consistent with discontinuities in pricing and risk and the supply of credit that we can plausibly understand in this context of trust, in that investors initially placed trust in the functioning of various technologies in various markets, and they had their trust broken when they observed events that were incompatible with the trust. Now, the second application to this is financial advisors and wealth management. Now, I think trust has been recognized previously as being important for clients to delegate their wealth and their savings to financial advisors and wealth management firms. But in particular, over the last number of years, wealth management, as well as other markets within finance, has seen a lot of changes. And in particular, this is one area as well where we've seen a big influx of financial technology. For example, things like robo-advisors. You just take an app on your phone, click a button, and it tells you what to invest in. And some people have been moving towards that rather than traditional wealth managers. So this offers opportunities and challenges as well. And some people, as I mentioned, really see this sort of influx of technology as a real game changer in terms of how the functioning of this market is going to evolve in the future that we really don't have the means to properly analyze. Now, a key point that Bob has really emphasized in his talks and presentations and in conversations is that I think his insights illustrate that we do have a framework to understand this as well. And really, trust is going to be fundamental in understanding how wealth management and financial advisors may evolve in the future, even in the face of these big changes within the industry. So he highlights 3 points that I'll try and summarize now. The first is that a client and advisor will share the objective that their relationship will hopefully last a long time. And that's kind of the goal at the outset when you try and pair with a wealth management advisor. But there's going to be some threshold of poor performance at which the client leaves. So the client will be able to tolerate a certain amount of bad performance, but the performance gets bad enough, the client will leave the wealth advisor. Put differently, the greater the degree of trust that the client has in the advisor, the higher this threshold will be. So trust is therefore a valuable asset for a financial advisor in order to retain clients against competition. And the prediction that Bob has that's based on this is that things that foster trust for financial advisors, so advisors and institutions with strategies based on maintaining and restoring trust by minimizing things like conflict of interest, so for example, having fee-independent or fee-only independent advisors, will be the things that will tend to disrupt traditional product-based wealth management models. The second point that he emphasizes is that the introduction of fintech into wealth management will be limited to the extent that it relies inherently on opaque products and technology alone. And in particular, in these cases, verification of investment performance may be especially difficult. And the only means of providing these types of products and services will be through trust. And basically, the ability of fintech to disrupt and really survive in this sort of environment will be based on its ability to generate and maintain trust. So I was just browsing online, and I found basically, I think, a good example of this sort of concept. So I remember I was visiting Boston a few weeks ago, and I had a wonderful conversation over a few hours with Bob. And one thing he talked about was basically dimensional fund advisors. And that one big advantage that dimensional has is its ability to maintain the trust of its clients. And I thought this was a very nice example of this. I didn't know about this before, but this is a screenshot from, basically you can view it as a fintech application called Money Owl. And so it's, again, one of these. You could view it, they pitch it as partly a robo-advisor, and partly there's a human on the other end giving you some advice. But their big pitch here is that they're fintech, and they actually also allow you to invest in dimensional funds, which I thought was a very nice thing that illustrates the point that he was trying to make here. And in particular, their big advertising pitch is that you want to invest with whom you can trust. And so their ability to invest in the dimensional funds, they really pitch as giving them a big edge versus their competitors. The final point here in connection to financial advisors and wealth management is that there's a big implication for regulation and regulatory actions as well. And in particular, we can view regulation as being one means with which we can cultivate and strengthen trust. And so some things for this are things like a fiduciary responsibility for financial advisors. Now, of course, there's a lot of controversy with this and a lot of sense that there's not much clarity with regard to what a fiduciary duty is. But something along those lines, as long as it's clear, may be a means for strengthening trust and may help with a lot of things in a lot of these changes. To the extent that information is not inherently opaque or complex, mandated disclosures can be used to encourage transparency and then foster trust. So if I have time, I'll try and talk a little bit more about that particular point. So the takeaways with respect to financial advisors and wealth management in this framework that Bob has developed is I think that the functions of wealth management, the important thing to note is that they remain the same, even with these big structural changes. The functions are that we still want to be able to give our money to someone who basically will be a steward of the money and give us a certain return. And it remains the same even with the introduction of fintech. And the punchline here is that institutional forms that may deliver these functions will be especially important, and also with respect to how much they can hold and maintain trust. Now, another area that has seen a lot of changes is lending. So we've seen a lot of non-banks and fintech lenders, so for example, peer-to-peer platforms, individual companies that use technology like Rocket Mortgage to originate loans that don't flow from traditional banks. This is something that we explore in particular in our joint work on trust and lending. And I think that this sort of situation also can be viewed in a framework of trust. So the starting point that we have here is that the lending functions of banks and non-banks, such as fintech firms, are the same. They're both providing debt financing or issuing loans to clients. But the thing we highlight here is that each type of firm has different institutional features. So in particular, going from Bob and Svi's previous work, deposits will provide banks with a valuable source of financing and rents, but the depositors are also customers that don't want their service provision, so for example, safekeeping, advice, transactions within banks, to be jeopardized by the bank's credit risk. The key results that we have here to kind of parallel what I had mentioned earlier on is that first, trust will allow a lender to raise financing at the best possible terms. The second is that we show banks have endogenous incentives to try and develop and maintain trust through making good loans as opposed to bad loans because of their ability to collect deposits due to the customers providing that sort of financing. Third, loan deposits in good times can cause a loss of trust, or loan defaults, rather. So put differently, if you observe that a loan defaults and things are going very well in the economy, it's very likely that the loan defaulted because the bank made a bad loan. In contrast, if the loan defaulted and things were going poorly in the economy, you can attribute that to basically the economy doing badly and bad luck. And finally, which I think is a powerful insight that Bob has been emphasizing in a lot of his talks, is that if trust is lost, if we have something like a crisis that erodes trust, a prediction from this is that banks will be better able to survive this loss of trust, but non-banks like fintech firms may not be able to. So trust is important for both banks and newer entrants like non-banks and fintech firms, but it's essential for the fintech firms to survive. And so if we see something that erodes trust, like another crisis, a prediction is that this may cause borrowers to flee back to banks. I'll very briefly go over this, but I think another important implication of this framework is that it can help us to understand things like blockchain and digital currencies like cryptocurrencies. This is something that Bob has emphasized in a number of his talks. He notes that blockchain and digital currencies have the potential to make a large impact on financial markets, but trust is implicitly important for these to function as well. Blockchain, for example, uses a consensus mechanism along a lot of different record keepers, and so incentives will be important in terms of that, in particular with trust. And overall, the emphasis that he has in the conclusion is that blockchain and digital currencies will not be able to succeed unless they're widely accepted, and they won't be widely accepted unless they're trusted. And so this was a documentary from a website called TechCrunch, where they basically buttressed this argument. And they talk about trust in terms of Bitcoin and blockchain. I'll just spend a couple of minutes on this. This is ongoing work that Bob and I are collaborating on right now based on some of his previous ideas. And the idea here is that trust can interact, I think, in interesting ways with respect to the information environment that companies operate in. The idea here is that companies can choose a level of informational transparency. So companies generally or very frequently disclose information to investors and to the market in general. And the idea behind this is to understand how this can potentially substitute for trust. So for example, during the financial crisis, an open question is, could some firms have continued to access financing if they were not so opaque, if they had just provided additional information? And there are a lot of trade-offs here, which we're trying to essentially formalize. But the idea here is that information disclosure, in general, allows access to more financing. So the idea is that the more you disclose, the better the terms you'll get from investors, and the more money you're potentially able to get in to your firm. But the trade-off is that any information you disclose may also leak to your competitors. And this is essentially the classic trade-off for information disclosure that we have in the economics and finance literature. I think some of the important insights here is that trust can interact with this framework in a lot of interesting ways. One insight here is that trusted institutions may be able to afford being more opaque or disclosing less. You may actually find that if you trust a firm more, they'll actually disclose less information. The second is that transparency may substitute for trust. So if you don't have trust, there may be some cases where you can disclose more information and get at some of those benefits of trust, as long as that information is not too complex. And then a third mitigating factor here is verification. Simply put, that you see that something works, which may be an alternative for both. So this is ongoing work, and I think this has potentially a lot of interesting connections to a lot of strands of economics. And I think it has important consequences for a lot of things like regulation, understanding funding markets, and liquidity, and in general, how much money companies can get. So I'm basically out of time. I don't want to keep everyone from lunch. This is the summary of the key takeaways that I think we gain from Bob's framework of trust and the functional perspective when we combine the two. Things like the financial crisis, that risks were not priced beforehand, can cause sudden shifts in pricing and markets to freeze. Asset management in general, that trust is a valuable asset that can give managers a competitive edge in the face of big changes in the industry. Lending markets, that trust is a valuable asset that allows companies easier access to funds, and it's essential for non-banks and fintech firms to survive. Things like blockchain and digital currencies, which are dependent on trust, and then interesting implications on transparency. So just to conclude, and just a couple of thoughts going forward, I think that Bob's functional perspective, in general, has struck a rich vein of economic insights in both financial intermediation with respect to banks and in general for financial markets. And I think that his perspective on the role of trust in financial markets has the potential to further open up an area of inquiry that I think has far-reaching implications for understanding both banks and markets in general. And I think that the regulatory or the potential regulatory implications of understanding this framework are potentially profound and, as I tried to emphasize, can help us to understand some really fundamental shifts in the market. And he's been actively promoting many of these ideas in his presentations, as well as some of the joint work that I've had the privilege of collaborating on with him. And as some of them take more formal shape, hopefully in the years to come, I hope that it will have a significant impact on advancing our understanding of a host of issues. So thank you very much.